Well, here we go again. The Dow is down 950 points. It's getting worse. So today I went into my wife's 401k and I was going to change the allocations. And the minute I get in there, there's this big red triangle saying, "We are monitoring this volatility. Don't change your allocation. Hang in there." And I'm thinking, boy, this is some bad information, because her allocation was 80% large caps and 20% bonds. So the big question is, does this make any sense? Does this hold water? So let's take a look. Everybody, the pundits say if you miss the 10 best days in the market, you will be really hurt. So let's see what's happened in the market since 27. The cumulative return, if you just did nothing and hung in there, was 11,440% upside. Now, if you missed the 10 best days, you only had 3,728 upside. So that is a big deal. But if you missed the 10 worst days, you would be up 36,100%, which is kind of weighing it for being risk averse and not necessarily going for the return. And if you missed both of them, you'd be up, the best and the worst days, you'd be up 11,908, which would be a little bit better than just hanging in there and doing nothing. So I don't think it's really good advice for people with a retirement account, and their 401k is arguably probably their largest holding in the market, to sit idly by when the market is crashing like this. So I moved her portfolios much more conservative. But let's take a look and see what volatility does to a portfolio, whether it's a 401k, no matter what it is. So this company is in Australia, but the information and the idea is the same. What they do is they look at return with a lot of volatility and a return with very little volatility. The first one is a short term. It's like 3 years. So portfolio one, you start off with 100,000 and you just make 15% cumulative, and you end up with 152,000. Portfolio two, you still make the same 15%, but you're up 35%, down 30%, up 40%, and with that volatility, you only end up making 132,000 with the same return. So let's and you can see how this works out over the 3 years. But let's look out a little farther. Now this would hold true whether you are in the accumulation phase, you're saving for retirement, or the distribution phase. So let's look at, we start off with $100,000, and here you have the same 15% cumulative, and over here you have the same up 35%, down 30, up 40, up 35, down 30. I mean, this thing is really volatile, but at the end of the day, both portfolios make 15%, but this one is at 1,800,000 and this one's at 709,000. So it makes a huge difference over the long term to actually hedge out, or not have so much risk in a portfolio. It's probably just as important as what you select for the investments. So this is another thing. It's the arithmetic of losses. And the reason I actually decided to rebalance the 401k is this is my main thought when the market starts getting really volatile. So this is what it takes to get over an investment loss. So her portfolio was down like 10, maybe 12%. So to get back, you have to make 11% to get back where you were. If you're down 20%, you have to make 25% just to get back. So there's a line in the sand you have to consider to where you've got to cut your risk, because you don't want to spend a lot of time getting back to where you just started. So if you go clear out to like the 2007, 2008, where you're down 50, you got to make 100% just to get back where you were. So I would rather limit risk and say get down for 10% and then go really conservative and see, let the market do whatever it's going to do, and then you get back in, because you only have to make 11% to get back where you were. So this also works. There's a sequence of return risk. This is for retirees, and they could still be in a 401k. They could be in their IRA, but the idea is volatility can really make a difference in your investing. So this is this piece is from BlackRock, and this starts out with, I think, $100,000 and at the age 40, and the sequence of returns are like this. Mrs. Jones starts out with 22. She starts with her portfolio up, and then with losses at the end, and the overall return is 77%. Mr. Smith has exactly the same returns, but they're upside down. He starts off with losses and ends up with gains, and they make the same amount. And then there's a straight 7% for Mr. Brown, and all three portfolios made 7%. And the sequence, where it came from didn't make a lot of difference, and they all ended up with $5,400,000. But when you go in the distribution phase, and now you're retired and you're living off your investments. Now this assumes you start off with $1 million at age 65, and you withdraw $60,000 a year, adjusted annually for inflation, which really isn't a big deal, and all had an average of return over 7% over 25 years. So once again, Mrs. Doe starts out with the gains, and then there's some losses and gains and losses. She ends up with $1,099,000. After taking all that money out, she ended up with the same amount, a little bit more than she wanted. Mr. White, on the other hand, they're all taking $60,000 out each and every year. Mr. White starts off with losses and then ends up with gains, but he runs out of money at 88. And then Mr. Rush, he had the 7%. He ended up with $430,000. So when you're retired, the sequence of returns and this volatility can make a huge difference. And it's markets like this can be devastating for retirees. So what did I do? I model portfolios and this Stock Rover is an absolutely fantastic tool to figure out what you want to do. It gives you beta, it gives you returns, it gives you historical returns. So to make a long story short, as most 401ks, they don't have a lot of selections, but they generally will have a bond fund, and they will generally have a target date fund. So what I did is I put was actually at 25-75%. This is 25% bonds. The VBLTX is the same thing, total bond. Except I had to get the percentages right. I had to use a mutual fund. So today, current returns, today this portfolio was up a little bit. So it has a very low beta. So this portfolio can ride out whatever's coming. And if it won't make any difference if this portfolio can't survive. But this is how you limit your risk, and you're not going to get great returns. But at this point in time, in this market, you don't necessarily want great returns, because that means you're going to have to take on more risk, and it will not end well in this market. So let's assume whatever they come up with a cure for the coronavirus, or something happens and the market turns. What you do is you just go back to your other allocation. So this isn't nothing's really for forever. And everybody says, well, you should buy and hold this forever. You can. It's not optimum, but I mean, you can do it. But the results, depending on when you plan on retiring and how much you want to have, when you retire, will make a big difference. Your time horizon on how much money you're going to have when you retire. So, in my opinion, whether you're going to retire, whether you're not, it's best just to miss this volatility and invest like they did with Investing, where you reduce your volatility and you actually get better returns. That would be for accumulation. That means saving for retirement or distribution. So my portfolio, and in case there's a recession, this is my portfolio, and it was hedged today. And you look, and my gosh, this portfolio really took a beating, but the hedge saved the day. And it puts out 14%. And this, I really like this stock, but the market doesn't. So very soon, I'm going to sell one of my other holdings and buy more of this. This is a 22.1% dividend yield. And this is the kind of opportunities you get when the market starts getting a little crazy. But that being said, you're better off to get, the target dates, you're better off to change your allocation on your 401k, which is your biggest investment for most people, to minimize the risk and maximize returns. It just makes sense. So in this particular scenario, we don't know how far the market's going to go down. We don't know what's going on with the coronavirus. The market doesn't trade on fundamentals. Yesterday it went up 1,000 points because Joe Biden won in South Carolina. This market is dangerous, so it's wise to just say, okay, I'm going to way lower the risk, and we're going to sit back and see what happens. So that's it for today. If you like the presentation, hit subscribe. I'm going to be doing more, but I want to do more on safe investing. But all of a sudden we have all these emergencies, which is good and bad. But I feel the need, like I've been an advisor for like 12 years. I've been through this. I know what kind of devastation it can have to portfolios, retirees, and so I felt compelled to do this. So I hope it helped. If you like it, hit the subscribe button, and thank you for watching.